Here's the playbook Washington won't admit. Your trucking insurance is soaring not because you're reckless, but because the system is built to bleed you. In courtrooms, in repair bays, and in boardrooms that treat small carriers like an afterthought. And you pay the bill for everybody else's bad incentives. Start with the basics the industry won't say out loud. Insurance is your second biggest fixed cost after the truck payment, and it does not care if rate is soft or spot rates collapse. In 2024, total cost per mile dipped a penny thanks to cheaper fuel, but strip fuel out and non-fuel operating costs hit a record. Translation, your overheads getting heavier even when diesel gives you a break. Premiums don't float down with rates. They rise on their own clock. Now the headline the lobbyists hate: truck insurance premiums are climbing faster than almost any other line. In the last cycle, insurance jumped double digits per mile after years of negligible change. That's not rounding error. That's a tax on survival for small carriers. And survey data showed premiums still leading the pack into 2025. This is structural, not an unlucky renewal. Why? Because everything that feeds claim severity has been supercharged. Repair costs have exploded, not just parts and labor, but ADA's calibration that turns a fender bender into a four-figure invoice. A scrape today is $1,000 sensor replacement tomorrow. Higher severity equals bigger reserves equals higher premiums. It's math, not a conspiracy. Layer on the risk that insurers price in long before you ever file a claim. Cargo theft at record highs. In the past year alone, thousands of thefts were logged, with losses climbing into hundreds of millions. Underwriters see that trend line and they don't debate philosophy. They push rates. That hits motor truck cargo and increasingly the liability equation whenever theft chaos fuels opportunistic claims. And yes, the courtroom. Social inflation is a polite way of saying nuclear verdicts 10 million and up are back and growing. Plaintiffs' tactics, third-party litigation funding, and runaway non-economic damages jack up settlement expectations industry-wide. Even if you never see a jury, your renewal pays for the weather in those courthouses. Now, some will tell you nuclear verdict talk is overblown. Fine, let's grant the debate. But here's what's not debated. Commercial auto lines have bled underwriting profits for years, and actuaries blame both economic inflation and litigation trends. When a line bleeds, carriers either raise rates or pull capacity. You've experienced both. And above all of that, there's a squeeze you never see: reinsurance. When reinsurers insist on higher prices and tighter terms after years of shock losses, primary carriers pass along the pain. You don't get a meeting in Zurich. You just get a bigger bill in Charlotte or Dallas. So if the game is rigged, what can you actually do? Here's the part bureaucrats never emphasize because it puts you, not them, in control. First, control the only scoreboard underwriters really trust: safety performance. Carriers that beat premium hikes last year did it with stable CSA, zero moving violations, clean inspections, and no claims. Not glamorous, but it works, and in some cases led to flat or lower renewals without raising deductibles. Second, weaponize video. In-cab cameras, road-facing at minimum, are evolving from nice to have to no video, no quote. Carriers are already seeing credits or equipment subsidies, and FMCSA's crash preventability program now leans on evidence like video. Cameras don't just win arguments on the shoulder. They raise phantom risk from your file. Third, fight the paper war like a pro. The boarding admin moves matter. Multi-year CDL, license and domicile in the same state, no gaps in coverage, and a documented maintenance plan. Bundle coverages where it makes sense to avoid double paying deductibles on a single event. Keep loss run requests current. Underwriters hate uncertainty. You get charged for every unknown. Fourth, get honest about equipment and lanes. Newer trucks are easier to place. If you're running older iron, get it inspected. Prove the maintenance and avoid the sloppiest freight lanes for a quarter of or two while you rebuild your story. Certain states and lengths of haul are simply priced higher. The fastest way to a better renewal is to stop driving underwriters the worst case routing to assume. Fifth, treat claims like a crisis communications drill. The clock starts at impact. Photograph everything. Call your agent and your attorney before you apologize to anyone with a clipboard. If you have a video, secure it, back it up, and make sure the chain of custody is clean. One preventable claim can cost you for 3 renewals. One well-defended claim you never pay can save your business. Sixth, use the market to your advantage, but don't lie to it. Shop at renewal with a broker who can actually place you, not just spray apps and ghost you. Accurately list drivers, garaging, radius, and cargo. Underwriters will find inconsistencies and you'll get surcharged or non-renewed. In a hard market, credibility is currency. Seventh, innovate at the margins. GPS asset tracking can earn credits with some carriers. So can telematics, coaching, and verified maintenance intervals. Not every insurer discounts dashcams or GPS uniformly. But when it lowers your loss probability or speeds recovery after theft, somebody will price it in. If your current carrier won't take the documentation, take to the one that will. Finally, understand the politics driving your bill. When enforcement fails, when regulators fumble basic standards, when fraud and staged crashes spike, that risk doesn't vanish. It gets repriced into your renewal. Whether you blame policing or both, insurers respond the only way they can. They add margin for uncertainty and pass it along. You pay for chaos you did not create. But here's a path out. The carriers who beat the market look boring on paper and dangerous in court. Boring because the numbers say low risk. Dangerous because they have video, documentation, and counsel on speed dial. They won't win every battle. They win enough that underwriters start to want them back on the book. Here's the practical checklist if you want to stop the bleeding this renewal. Fix the file. Pull your SMS snapshot and dispute junk crashes through CPDP. Add video everywhere you reasonably can. Document maintenance, training, and lane discipline. Then make sure your application matches reality. Pre-underwrite yourself. Assemble 5 years of clean MVRs, loss runs, equipment lists, garaging addresses, driver resumes, and written safety program with coaching and corrective action. Underwriters price the packet, not the promise. Shop smart, not loud. Use a broker who can reach markets that actually write your profile. Ask which credits each market recognizes. Cameras, ELD analytics, GPS, theft prevention. Bring proof, not vibes. Think structure, not just price. Consider higher deductibles only if your cash flow can absorb them. Explore captives or group programs. and only if your loss history justifies it. The cheapest premium that bankrupts you on a claim is not cheap. Control what you can. Every week. Clean inspections. No moving violations. Zero preventables. The carriers whose premiums actually dropped did not just get lucky. They started the claims beast for 12 months and the market rewarded it. What's the alternative? Wait for the insurance to soften, for jurists to get modest, for cargo thieves to find a new hobby. That's not a business plan. The only plan that works is the one where you make yourself the worst target for plaintiffs' lawyers, the least interesting risk to an underwriter, and the best documented carrier in your lane. Here's the truth the big guys already know. Insurance is a negotiation conducted in numbers. You can't argue with it. You can only feed it better numbers. Lower CSA, fewer claims, video on everything, tight paperwork, and no apologies for refusing to subsidize other people's chaos. Do that for a year, and your renewal stops feeling like extortion and starts looking like leverage. In a market built to punish you, that's how you flip the script. I'll see you next time. Bye-bye.